Um, we're going to talk about tax structures, right? This is what people are here to listen into. And we're going to go through these 4 most popular tax structures that are out there for people to utilize. So we're going to go through each one and then also talk about some of the most common questions that people like to ask about these tax structures. And so hopefully along the way, it will help answer some of your questions that you have. So let's go ahead and talk about this. Ying, I know there's a lot of folks who are sole proprietors, right? Sole proprietors. Yes. And so as a sole proprietor, they have questions about liability. They have questions about risk, and what would be the biggest reason for people to change from a sole prop structure to a different kind of structure?
So let's start by saying why people even get into sole proprietorship, right? And in US, there is an advantage for small businesses. When you just get started, you don't have to spend a penny on legal costs. You can just go in, do your business as a sole proprietor. So for example, a mama papa shop restaurant started, and dad knows how to cook, so he started this little restaurant, and it's just under dad's name with his social security, and no legal formation needed. Is a sole proprietorship. However, your restaurant growing, and then you start making money. And when you start making money, and pretty soon, if you make $10,000, you thought the tax was reasonable, it's $1,500. But as soon as you make $100,000, then your taxes become $15,000. And if you happen to make $200,000 profit, then you're paying $25,000 self-employment tax plus another $25,000 income tax. So there you go, $50,000. It will go to taxes. So for a lot of reasons, and they want to change sole proprietorship to another entity type, is tax-driven. But there is also another reason for people to look at sole proprietorship and it just suddenly felt it doesn't fit me. For example, if folks borrowed money for the business and tie it with a sole proprietorship, it will tie with your house, tie with your car. You have to file personal bankruptcy in order to get rid of this business liability. But if you started your business in an entity, it is almost like you're not the business, and the entity itself is become a business, is outside of you. And when that separation happens, when your business got a number, not using your social security number anymore, your business become an independent person, and that liability can stay with the business. So this is where, for liability, people would move out of sole proprietorship, and for taxes, they would move out of sole proprietorship. Then you probably ask me, I know, Dan, one time you were, one of our clients were saying that, well, if that's the case, I should just move out of the sole proprietorship. After we look at his taxes, and we conclude that, no, you stay here. You stay as a sole proprietor because it's good for you. In that case, what happened was the gentleman's business has been losing money for the second year. So the first year he lost $50,000, but he has a W-2 of $50,000. So that was perfect. So $50,000 minus $50,000. So he didn't have taxable income, but his employer already withheld a lot of taxes from his W-2. So all of that came back to him as a refund. All right. And then because it is a second year, and so the business still starting, on the second year, he still lose money, but not $50,000. It was only $5,000. In that case, we still want him to keep it there, and until the business start making money, then we can move that into a different entity to save taxes. If you have a loss, it's always very convenient for you to deduct your loss. Of course, you have a loss for several years on Schedule C, you're inviting IRS to look at you goes, are you sure this is your business or it is your hobby? How are you going to demonstrate your business is a business, not a hobby? There is a couple of factors you need to consider. Number one is how much you work on it. Let's say you only work on it once a month, okay? Or you don't even work on it at all. Money just flows in on its own, okay? So if those kind of things happen, it's not a business. It is your hobby or it is your investment income because you didn't even do anything, right? So they look at how much energy you put it in. Then they also look at whether you have other income that is taking up most of your time. Then you have this small hobby going on. For example, there's a very famous tax court case, which is a cosmetic surgeon, and he has a hobby, well, IRS calls it a hobby, and with a horse farm. So he makes, of course, a lot of money from his W-2, which is the hospital pays for his W-2, and so he already making $500,000 on W-2. So he has a horse farm that is on the side. IRS believe that's not a business, is a hobby because he never made any money. It was always losing money, okay? So that particular case, the doctor was ruled as having a hobby. So all of the house farm related expenses wasn't deductible, okay? But if I were the one, if this person happened to be my client, then what I will probably do is to look at what activities that he did with the horse. And I am hoping that he actually bought and sold horses every year. I'm hoping that he probably breed the horse and they go on the show. So I would spend time to calculating the time and the investment. Even when he was working for the hospital between surgery, he probably were online searching on horse competition and things like that. I would conclude all of these time together to see whether that would constitute a full-time job. So of course it wasn't my case, and when I look at it, it's already done. But this just gives you an idea of why people, when you lose a lot of money on Schedule C, it could easily be viewed as a hobby. Then you lost all the deduction.
Right. That's an important thing to know about sole proprietors. And a lot of people create a LLC and they become, maybe they're by themselves and they own a single member LLC, and they still don't know why they are filing their Schedule C and are still considered sole props. And it's very easily misunderstood, but IRS views if you're a single member LLC, you are still considered a Schedule C entity. So you need to bring a separate owner. Maybe it could be your spouse or it could be a business partner that you've known for a while, and to just bring that on there if you want to take your business out of your personal taxes. Ying was mentioning about how there's a lot of people getting audited under Schedule C because IRS does typically look at people with a Schedule C, understanding that they are typically new business people and they are more prone to making mistakes on their taxes. So if you want to just completely do away because you now have a bigger business, a bigger operation, and more risk to consider, then you want to bring in a second partner, right? So that's one of the questions, Ying, that we get a lot, right? For multiple owners, is the LLC really my best choice? What do you think?
So LLC, out of all the entities, LLC has a characteristic of being flexible, very flexible. It can turn itself to be a sole proprietorship, literally. So you will file your LLC results on your 1040. Then you ended up with a Schedule C, right? The Schedule C is just the one we were talking about, sole proprietorship. And it has its own drawback. Sure, it is easy. It's one tax return. You don't have to pay your tax preparer twice for filing your company taxes. But the drawback is that it is part of Schedule C, and the Schedule C is a place where IRS really likes to look at the taxpayer, because majority of the Schedule C filers are new small businesses, and the people who didn't really know the rules, maybe deducted incorrectly. You know, we have to admit that those are the places where most of the mistake would come from, right? So with that and your LLC, you could spend your dollars on legal side of it, but you still ended up to be treated like a sole proprietor. So that's what Dan was talking about, single member LLC. And when you have a single member LLC, know that the only difference between sole proprietorship and the single member LLC, it is that legal structure, that what the attorney told you, that this will separate your liability from your sole proprietorship. And, you know, based on the attorney, our firm, we have attorney in our firm. So based on the lesson we learned here is that, for example, you have an LLC and you did something wrong, your client sued you, right? Sue you, and for compensation. Say you lost the court. Then you will have your LLC pay for it. If your LLC couldn't pay for it, then your LLC can close, can file bankruptcy. Because it's a separate legal structure, your business happened inside of LLC. But if the same scenario happened, you got sued, but you're having a Schedule C, you're a sole proprietor without a legal shield, then you will personally be liable for sure. Okay? You could still end up personally liable in the LLC, but we're talking about maybe you can thinking of that putting a roadblock in front of you so people can't reach you that fast. They have to go through LLC. They have to destroy the LLC before they come to you personally. So the LLC formation itself do have merits. It is important, especially if you are in a more risky business. You know, when I say risky business, is the businesses that could cause personal injury. For example, if you have a massage business, okay, and you think you are just massaging people, but you may break their neck bones, right? So I call that more a risky business. And even the hair salon, you could be accidentally cut the beautiful hair too short, and that's devastating. That can cause a lawsuit too, right? So with those kind of consideration, if you go to any law office, the attorney would advise you to form a corporation or form a legal entity. But from tax standpoint, what we want to tell you is single member LLC is treated exactly the same as a sole proprietor. So sometimes we have clients, husband and wife are doing the same business, but somehow the wife was never on the return, never on the LLC, even though they're married, but just husband's name on the LLC, so it's a single member LLC. In this case, and we would advise people to put the wife on the LLC. The reason is for tax purposes, and you will become a partnership, so your tax return is filed separately from your Schedule C. So you don't file Schedule C anymore, and you don't have that 65% of chance to be audited anymore. So you will have your entity running income statement, balance sheet on its own, okay? And then you only receive K1 onto your 1040. So this is where when we think of risk in audit and we think of these entity type, I would tell you that sole proprietorship has the highest risk to be audited. Single member LLC has the second highest risk to be audited, and a multiple member LLC and has a lower rate to be audited. S Corp and C Corp is even lower. So this is just from I guess, just from the audit standpoint. But from tax standpoint, it is very different. Depends on the rest of your income, how you are, okay? Just like earlier, I was saying that if you have a small business and you're on your own doing sole proprietorship, and you have a negative bottom line, that might be a good one for you to offset your W-2. And a lot of people start something small like that, then accidentally becoming a bigger business. And when I say accidentally, just means they didn't plan for it, but it just happens, right? So if that happened to you, you want to move your business out of the 1040 and have it stay on its own to file taxes.
So when there is a multi-member LLC, we consider that as a partnership return, okay? As a partnership return and as an LLC, this is where Ying was mentioning about the flexibility that LLC provides. So LLC actually is the only entity where for tax purposes, you can actually make it very flexible between, let's say you and your wife are running a family business, and then you're the one running around and doing all the business, but your wife is the one actually just monitoring how the bank account looks like, right? So she is just there to be your moral support. So when you go at home and you're tired, and she perks you up and makes you feel like you're a winner, and then she looks at all your financials, but she's not really the one that runs around and sweating and doing the business. Here in this case, you can actually separate your roles, even though you're both 50-50, let's say, owners and members here, we say. Then you can be yourself as the active member, and your wife can be the passive member. So tax could be very different in that situation because, you know, as a 1065 partnership, you can be taxed as a self-employment tax if you're active. And if you're passive, that self-employment tax of 15%, you can forget about it, right? So you can actually absolve from being taxed additional 15% on your 50% share of ownership. So this is where the LLC can be very flexible for you in terms of that type of tax treatment. So you can save in that way. Now, if you want to completely do away with paying self-employment tax of 15%, we can actually take you out of the LLC partnership 1065 return and put you in maybe like a corporation. That can be like your C Corp, that can be like your S Corp, right? So Ying, what do you think is the most common tax structure for a small retail store?
Most of the retail store, when they get started, and they would want to set them up as a S corporation. Let me explain to you why they started that way to begin with. The retail store, you can imagine that you must be facing clients. They coming in, they shop at your place. The stuff they buy could have a risk, and they're in your store could have a risk. So you want to definitely separating yourself from that retail operation. So you're thinking of either a LLC, a S Corp, or C Corp, right? So now the reason people do the S Corp, because most of the retail store also have employees. And you don't run it just by yourself. If you have employees, and then the LLC, normally when you have an LLC, if you're just husband and wife, you don't even have to do payroll because your leftover will represent your payroll, so you have no requirement for payroll. But if you already have an employee, you're going to do payroll anyway, then it makes no sense to stay in LLC. You might just as well do an S corporation. Because when you pay, as long as S corporation has an employee, then that's where you can actually do the W-2 to your employee. You can start paying yourself on the salary as well. Or maybe your S Corp is not making money, then you don't pay yourself. You only pay your employee. But S Corp has a character. You must have a payroll in S Corp. Very seldomly, the S Corp doesn't have a payroll unless the S Corp is operated by the owner themselves and also lose money. That justifies, okay, why you don't have payroll, right? Otherwise, for retail store, it is hard to get by without payroll because you must have someone working there. So S Corp would be most popular first stop for a small retail store.
You know, a lot of the questions that we also get are actually when people are wanting to know how to be part of the ownership. So let's say, I know one of the questions that we got were, I want to be part of the business, and what are all the documents you need in order for me to be part of the business? So typically, you know, my answer to that would just be, we need your legal name. So the way you file your taxes, we need to make sure it stays consistent. And then we need your social, and then we need your address. And that's about it. And we need to know how much shares you are going to sell to make sure that they have that ownership. And if you're going to have a monetary exchange, let's say you're going to sell it for this much, then we want to know as well, so we can record that on your legal documents. So, but those are the information that we would need in order to help do a ownership transfer. We call it ownership transfer. So let us know if you guys have any questions more about ownership transfer. We have been doing this for the last 20 plus years, and it is really nothing under the sun we cannot handle right now with this legal type of work. So I know Ying mentioned the S Corp. You have the employee requirement, a payroll requirement you need to have, right? So you also need to know, let's say you're a new business and you just didn't really have an idea and you became an S Corp, and you have a question on how much do I need to pay myself? Can I even afford to pay myself? That sort of question. And a lot of times it is on reasonableness that we can use to defend why you didn't run payroll maybe for the first year. So IRS really does care about all those. And if you don't have proper representation and you try to deal with IRS on your own, you don't know that, and you start freaking out about the letter that you got, maybe you just didn't have a better idea on how to handle that. So feel free to let us know if you have any kind of questions that come to you from the IRS. We are really familiar with IRS inside out. And so let us know, okay? So Ying, the next question that we have here is, what is the most popular structure for real estate professionals that you have seen in the past?
Sure, that's actually a very big question because real estate professionals are so creative. They're not just the people who have license and buy and sell, you know, homes and buildings. They can be a developer. They can be the kind of people that who look at the empty land and build shopping mall on it. They also can be the one that's spotting a really rundown building and flip it around and sell it. So, or they're landlords, right? So real estate professionals are a very broad concept of what people do. So in general, they're doing something with real estate, okay? And with that in mind, there's three types of entities are very often used by real estate business people. And one of the entity is LLC. They use the LLC to do a title holding work, which means they will put the building's title under a LLC. And they also often with S corporation. The reason they have S corporation is because they will use that corporation to do management work of the building that is sitting under LLC. So then you already kind of can envision a structure. So you have the building that you purchase under LLC. So that is protected by LLC, right? Then you also have your conduct, your activities, your connection with your tenant. They are all with your S Corp. So when tenant write a check to you to pay for the rent, they don't write to the LLC. They don't even know that building is actually under LLC. What they know is you're the landlord, I'm writing you a check. So let's say this tenant wrongfully dead in your building, okay? Let's say, so unfortunately, you as a landlord is responsible for, all right? And you lost the lawsuit and you are ready to pay $3.5 million to a life, okay? And in this case, your S Corp has no assets. All your buildings were under LLC. So the relationship between your S Corp and your LLC, it is contractual relationship. So you could lose everything you have under S Corp, but you will not lose that building. So what you have under S Corp maybe is your computer, your desk, who knows, and something minor. So you could fold your S Corp and regretting to do such a wrong thing, so you close your company and you don't have any money, so you file bankruptcy, and that would not affect your LLC because that is under a different legal entity, right? So of course, all of these work, a good attorney will do that for you, but we're just talking about when we have these structure in play and what happens, what is really happening here. And for us as accountants, what we see the benefit of that is your LLC filing is very straightforward because there's not much going on. And your S Corp is the one that is going to have a lot of transactions. So if you get audited, we hope that the IRS has no interest for your LLC, only going to look at your S Corp. And now there's one more entity is very popular to the real estate professionals. That's a C Corp, C Corporation. Why is that popular? Because C Corporation has a very unique way to pay taxes differently. And Trump made C Corporation a low rate of 21%, okay? So the most taxes you pay is 21%. Now, the most personal taxes we pay is double that, all right? So 21% is advantage, and it is a good rate if you have to make a lot of money, and you're certainly looking at that as an option. And C Corp also has something really interesting, which is what we call the fiscal year setting. So let's say your personal tax return is always runs from January to December, right? Because in April, we're filing 2019, we cover the period of January to December. If you have a baby on January 2020, you cannot put in 2019 because the year goes on the calendar year. The baby was born in January 2020, right? But in C Corp, it's not like that. The C Corp, you can decide on your fiscal year. So which means if you knew you're going to have a baby in January, you would make your fiscal year from February to the end of January, bring the baby in so you can have more deduction. So that's just a very silly example, but give you an idea. So sometimes you can push your income, you can delay your income by literally a year. If you have entities that is actually staggered, I think that's a English word, and then you have January to December, then you have November to October, right? What happened to November and December, this common 2 month period between two entities, their business transaction could happen and the business deals could happen. So there's all kind of ways to work through your planning of taxes. So as a real estate professional, I come back to my point that if you are a good real estate person, you really need to find a good CPA firm. And other than the structure I was talking about, there is two other concepts I want to just throw out here. If you are a real estate professional and you don't know how to work like-kind exchange, you don't understand the concept, you should see Community CPA, okay? And if you are real estate professionals and you have no idea what means cost segregations, you should see Community CPA. So those are, we call them essentials. They're essentials for real estate professionals so that you will save cash and invest more, pay less to Uncle Sam, okay?
So let's also further talk a little bit about the characteristics of C Corp and S Corp since we're already there, okay? So at our firm, we have a very interesting way of explaining to our clients about S Corp versus C Corp, right? S Corp is actually a subchapter corporation, and it is a loophole that was created for smaller corporations, smaller businesses. But we say S stands for socialism. And then C for C Corp stands for capitalism. So the way to understand that is, you know how socialism, everybody shares. Everybody has the same thing. If one person has one thing, another person has to have the other. And so S Corp is really the same in the way IRS views S Corps. So they will ask you if you're, as a business owner, you deducted some of your, you decided you got yourself a new truck, and they will ask you, did you also get your other employees a new truck? If you got yourself a new phone, they'll ask you, did you also get your employees a new phone? And so what you do for yourself, you also need to justify why you got it for yourself versus your employees if you didn't do the same treatment. So you want to carefully consider that and know that question is going to come, okay? So when you're dealing with S Corp, that's something that you have to remember. So as a C Corp, here, the C stands for capitalism, I mentioned. And why that is if you think about big corporations like Walmart, right? Wells Fargo, Apple, all of these big corporations are all C Corp. The reason why it benefits strictly the capitalists. Those people are at the very top, right? So the corporations, they have this specialized package for all the capitalists, for all the owners, right? So you can actually justify this specialized packages for the owners or the top people at the corporation and easily deduct it without IRS blinking, because IRS expects you to have that kind of specialized benefit package for the people who are owners. And so those are some characteristics that you will probably want to know if you are getting really, really big and you want to start planning out how to better treat yourself or the other shareholders at your company, right? So C Corp and S Corp, those are some characteristics you want to know. And some of the question, Ying, I know I just thought of is, what about day traders, right? We have a lot of people who are day traders. And what would you suggest to them?
So if you are a day trader, that just means you are doing stock market investment full time, right? And if you're doing that, and then your ultimate question is, you know, that trading account I have, should I keep it under my personal name, or I should move that into a company and form a company? So our answer to you is, for the short-term investment, like the wash sales, the one you trade every day, that account really should be under business account. And we will look at how much money you made on there to decide what entity we want you to be. So keep in mind, it is not like if you are so proprietor, you have to destroy everything you have, let go of the business name and becoming LLC. Then let go of the LLC becoming S Corp. No. Remember, it is almost like a caterpillar evolving to be a butterfly. So your entity type, you literally can keep it the same all the way through. So you may be LLC, then we can elect you to be S Corp. Your S Corp, we can move you to be a C Corp. So there is a transition. You don't lose the EIN number, the identity. So what we will say is that if you are a day trader, you make less than $20,000 a year on the net profit, you can stay under the LLC structure. But if you start making more than that, you're looking at S Corp. If you start making more than $200,000 a year, you're looking at a C Corp. So we're giving you a number that for you to keep in mind, okay? $20,000 for LLC and $200,000 for S Corp, and then above it is going to be a C Corp. Sometimes keep in mind your LLC could be multi-member, and then that will be, you have 2 members, it will be 40. You have 3 members, will be 60. So you want to kind of calculate that based on the member numbers. But you start with LLC to make that a daily trading account. So whatever you have in there will be written off as a business expense, and it will be taxed as business income. But if you have a long term, don't leave them in a day trading account. Leave them in your personal account because they have a very favorable tax rate as a long-term capital gain. All right? And then if you start making money, you move to S Corp and C Corp. So that would be a general guidance we have for day traders.
Yeah, what Ying was talking about is kind of like the growth chart. You know, we have the baby, we have the teenager, we have the college, and a fully grown adult. And it is kind of like that growth chart, right? You have the sole prop, then you have the LLC. It could be a single member LLC, and then it could be a partnership, and then it could be a S Corp, and then the C Corp. And so that's what we can call a growth chart. And so in consideration of that growth chart, except for the C Corp, everything else is what we call a flow-through entity, okay? Flow-through entity is basically what means at the end of the year, whatever is your net profit or net loss, you will have to report it on your personal taxes. So it has an affiliation. It has some sort of ties. So, you know, when you're working for somebody, you receive a W-2, okay? And when you are an owner, okay, you receive what is called a K-1, okay? And this K-1, we will report it to your personal taxes, and it can impact your personal taxes. And so you can pay more or you can pay less, maybe even get a refund. So that is something that you want to remember. But a C Corp is very different because C Corp is not a flow-through entity. So you don't get a K-1 at the end, okay? So for that purpose, people actually decide to have a flow-through entity, or they decide to have a not a flow-through entity like a C Corp, okay? So I know some people who don't really want anything to do with the company because maybe they have certain benefits they don't wanna let go of, okay? Because they don't want it to show on their personal taxes. They don't want anything to do with it. So they'll create a C Corp. So that is some understanding that we need to have when we're dealing with tax structures and when we're planning for tax structures. So at our firm, we dedicate our months of October and November for tax planning, okay? So our clients have that benefit. They know it's coming. And what we do is we look at the entire period up until October or November. Then we do a projection for the remaining months. And then before the end of the year, you know what your tax implications look like, right? So before the next year, our clients know how much taxes they're going to pay, or they don't want to pay. So we plan during those couple of months on how to make sure that we don't tip the IRS on taxes. And so those are some important things that we like to let our potential clients know. If you don't have that service provided to you from the past or currently even, then you know at our firm, we do provide that expertise to our clients. So I know one of the question is about if I have a full-time job, okay, and I am running a side business, Ying, what would be the best option for me?
So if you're my client you came to me and said, oh, you know, I have a full-time job, but I'm running something on the side, then I would be really interested to know how much you're making from your full-time employment. If you make, say, over 6-digit number, and then I would say that you want to set up your company not as a S Corp, not as a Schedule C, so that would just adding up on top of the income that you're already paying 28% taxes, right? Then I would be thinking of doing something more in LLC or S Corp side of things. But because S Corp requires payroll, then I also don't think it is beneficial right now to have you pay payroll tax, so I'll probably start you at LLC. And if you're saying that, well, you know, actually my wife's going to help me a lot more because she stay home and didn't really have a full-time job, then I will for sure bring her in to have her be part of the membership for you, even though you don't think that she is qualified to help you. So, but from tax standpoint, it will be a really good tax planning to make your wife have a actual business conduct, so qualifies maybe your baby's daycare deduction, because you both of you has to be working in order the baby's daycare to be deducted. So there's a thing that we can plan for a special situation. So, you know, in the end, the reality is there is no cookie cutter solution. You're not going to finish this webinar goes, oh yeah, I got it. Everything is straightforward for me. No, it's just going to make you realize that every case is different. And some people coming in, we say you run as sole proprietor. For now, you're good enough. But some of the people coming in, we say that you must file a C Corp. And why? Because this person maybe don't even have a social security number, or maybe this person is going through divorce. And there's so many reasons for us to consider the tax consequences for you, and especially if you're our client. So we really want to make that customized for you. And then there's so many choices, so many reasons for what we do. But one thing was so good about us is at Community CPA, I really don't believe in superior understanding. So if I cannot relay what I want to do for you to understand it 100%, that just means we're not doing it. Because we make sure that our client knows what we're doing, because this tax planning thing, I do the planning, you're the one carrying it out. So if you don't understand, what's the point for me to plan that for you, right? So it is really important for our client to know that you got your personalized solution here, and you also, your solution is not permanent. It is going to change with your business. Just like Community CPA, I'll tell you, Community CPA started as a sole proprietor, then LLC, then S Corp. Okay, I didn't really turn myself into a C Corp for good reasons, because I like socialism society, and I enjoy that sentiment, so I don't really care to go on to another entity, and I stay with a socialism society, so it just, everything is equal, and that's good enough, right? So there's reasons for people to do certain things, and we will definitely, give you that answer, make you agree with us, then we go forward to implement it. We do have attorneys in our firm, so there is nothing we cannot do in terms of implementing your structures. So I actually want to mention one thing that is kind of coming from the audience question related to audit, and I want to mention just one brief thing related to QuickBooks versus other accounting software. And can I share a screen, Dan, to the audience? I want them to see something I have here. I am sharing a screen with you because I want you to see a tax information document request. This is a Form 4564. This is an audit. This is the audit for a business, okay? And the reason I bring up here is I want to tell you that a lot of people are using QuickBooks. And QuickBooks, one thing about QuickBooks is that IRS has a license to use QuickBooks. So look at what they're asking the taxpayer to give them. They're not asking they're not asking papers. They're asking a copy of the original electronic backup file of QuickBooks records. That includes the period from January 1st to December 31st. This copy should not be an altered version of QuickBooks data, but rather a copy of original electronic backup file. And the QuickBooks administrator's username password for the backup file requested above. Please notify you may temporarily change administrative password, but you have to give me the administrative password. And what does that mean? That means if you are getting audited for 2014, you give the data to IRS. That's not just for 14. QuickBooks has no ability to give 1 year to outside. QuickBooks gives everything. So you give 2014, then they will audit your 15, 16, or 13, depends on which 3 years they have. In this particular file we have, this is a taxpayer walking into our office and already give the data to IRS, the QuickBooks data. And they think that they're giving 2014. Actually, IRS has 10 years worth data in their hand. So very soon, they expand it to 3 years. And one of the question is, why are you deleting about $1 million a year out of your sales? Why? We don't know why, because clients very not clean with QuickBooks. They don't even know what they're doing inside of QuickBooks, but IRS has the data file. They can trace everything you do. So for that reason, we always tell our client that maybe it is not a super good idea to use QuickBooks. If it is, that's what you are trying to keep your records, because you will get that when you are being audited, because IRS has the license to open the data file. And in our firm, we use Thomson Reuters Accounting CS, and that is proprietary software. And, I guess IRS could buy license, but it is so expensive they probably won't be able to do it. And it's a professional accounting software, and it is really has the ability to cut off the data into chunks. So we can give IRS a month or 2 months or 3 months or 3 years, however we want to segment it. So it is a software that professionally developed for today's industry. And so I want you to consider that when you work on the business. If you're thinking of starting a business, you don't even know how to use QuickBooks, don't even get there. Go somewhere else and do another software. Use Accounting CS, work with Community CPA. So that is one thing I want to show everybody. And I just think that it is important to answer this audit question with that, because whenever you get audited, we all have to show data to IRS. But the data you show, you want to have a control, and the QuickBooks doesn't give you that control.
Well, I know we are approaching our 4 o'clock mark, but I do want to show everybody our website. So I know you guys are at this time maybe familiar, www.communitycpa.com. All of our webinars, like the one we're on right now, are on our website. And we do a pretty good job of putting all the information as far as we can project. And so you can come here, or you can go to see previous webinars to see what you missed before, and then view these. And you can do this actually on our Facebook page or on our YouTube channel. And so all of that is available to you. So I want to go ahead and thank everybody for joining us today. And I know we have more questions we didn't have a chance to respond, but we will email you if all possible. If you just remember to email us, and you can email dan@communitycpa.com, and I will make sure that we have an answer for some of your questions that we didn't have a chance to answer. Okay, and when Ying was talking about not doing something where you don't understand is really the way our firm manages our interaction with our clients. And early part of this year, I'm gonna go ahead and stop sharing. Early part of this year, I had a client that came and came to me, and you know, she heard somewhere that she needs to do an election, and she came to me and she said, Dan, I need to do an election. And I told her, do you know why you need to do an election? And she said, no, I trust you guys. Just do it for me. And I asked, and I told her, you know, you could have done this anywhere else, and they would have just been like, thank you very much. I'm glad I don't need to spend all my time explaining, here's your final work. Here's your election, right? But at our firm, we don't really do that. It's not that we don't want you to trust us, but we want you to know what we know so that we can know that your future is somewhere that we're walking towards together. Okay, we don't want to ever do anything you don't understand, because that is just deceiving to us. And so we don't want to get there, and we want all of our clients to know what we know. And so even though we have a lot of clients come back during tax planning year after year, and we re-explain the tax structure, because that's our work, that's our job, but we do it because we want you guys to remember and to be refreshed on new ideas, and so we can strategically move forward. And we really do believe some of our clients that are still thriving during this COVID-19 is because we have been able to share a lot of important information with them. And it is just in our DNA to share. And you heard Ying talking about sharing. And it is something that we want to continue to provide every day, Monday through Saturday at 3 o'clock on this Zoom. And you can see the schedule I mentioned on our website. So we want you guys to continue to log on and learn during this time and even afterwards, so we can plan after this COVID-19, okay? It will end. We want you guys to continue to be safe and take care of yourself, so we can do this for the long run, okay? And thank you again for everybody for joining us, and we will see you again tomorrow and every day, as long as you need us.